Thanks everybody for joining us today. My name is Megan Moyer and I'm an attorney at Saul, Ewing, Arnstein and Lear in our real estate practice group. I'm joined today by my colleague, Fred Poindexter, who is also an attorney in our real estate practice group. And we're here today with a truly incredible group of panelists to present this webinar, Commercial Sustainability, Utilizing CPACE Financing to Reduce Costs and Accomplish Carbon Neutrality Goals. Fred and I are thrilled to have this group of panelists here today. They're all experts in the CPACE world, and we wanted to kick things off today by giving each of them an opportunity to introduce themselves and just talk very quickly about their experience in the CPACE world. Our panelists today, we have four. Jean Fields, Vice President and Commercial Community Development Lending Officer at Fulton Financial Corporation. Sheila Wallace, Director of Nuveen Green Capital. Leslie Smallwood Lewis, co-founding partner of Mosaic Development Partners, and Lisa Schulach, a consultant at the Philadelphia Energy Authority. Jean, why don't you get us started if you could just introduce yourself and talk a little bit about your CPACE experience.
Terrific. Well, thank you for inviting me to join the panel. As you said my very long title, so I won't do it again. But I'm responsible for financing community development projects in the greater Philadelphia area, primarily those that utilize low-income housing tax credits and new market tax credits financing structures. My experience with CPACE is that two of the projects that I finance acquired some CPACE financing after construction had begun. And one of them is a project that another one of our panelists, Leslie, well, everybody on the panel was involved in, and I think we're going to use as a case study.
Great, thanks, Jean. Sheila, how about you chime in next?
Yeah, sure. So director at Nuveen Green Capital. I focus solely on financing CPACE for Pennsylvania, New Jersey, and Delaware. Nuveen does finance CPACE across the country wherever it's eligible. As Jean said, I worked on a couple projects here locally in the state of Pennsylvania, also with Jean and Leslie and with Fulton Bank previously, and looking forward to hopefully doing many more and talking about that project here today.
Thanks, Sheila. Leslie?
Good afternoon. Leslie Smallwood Lewis from Mosaic Development Partners. So yes, one of our projects is part of the discussion for today, Golaski Labs. As Jean indicated, we brought in CPACE during construction. We were constructing the project during COVID and actually had some additional costs attributed to that. And CPACE was able to be brought in and really fill a void in a very efficient way. So we'll get more into the details of that as we talk about the project later on. But it's a funding source that I am actively looking to utilize in some of our other projects as we go forward.
Thanks, Leslie. And last but not least, Lisa.
Hi, everybody. Good afternoon. I'm Lisa Schulach. I'm with the Philadelphia Energy Authority, and we administer the CPACE program on behalf of the city of Philadelphia. And the reason an administrator is required is because one of the components of a CPACE project, which you'll hear about more, is that an assessment lien is placed on the property when CPACE financing is taken out, and that needs to be overseen by each county in the state. So we oversee it for Philadelphia, and the Sustainable Energy Fund is the program administrator of CPACE for counties outside of Philadelphia in Pennsylvania that have authorized, have made CPACE eligible, and we'll go into a lot more details on that. And I'm glad to be here with you this afternoon.
Thanks, Lisa. Before we jump in, just to give you all a quick overview of our schedule for today, we have a series of short slides that just provide a general overview of CPACE, CPACE in Pennsylvania, CPACE in Philadelphia. My colleague Fred is going to run through those. Our slides will conclude with a case study on the Golaski Labs development project you've heard most of us talk about already, which is a really great example of how CPACE financing works, and is the perfect example for this group of panelists who have all played a role in that development project. So we'll dive in there. You'll get to see firsthand the various actors and the ways in which CPACE financing was used to make that project come to life. We'll then have our panelists open up into a more of a free-form discussion to talk about their general experiences with CPACE financing. And finally, we'll wrap up with any questions at the end. If you do have questions for our panelists as we dive through this presentation and as they're speaking, please feel free to use the Q&A log button on your screen to post your questions, or you can hold them till the end and we'll address them at that time as well. I will now turn things over to Fred.
Okay. Thanks, Megan. Thanks to the panelists. So before we jump into the discussion, we'll take a brief high-level view of basically what is CPACE for those of you that are new to the concept. So essentially, it's a form of low-cost, long-term financing for commercial properties, and now with the recent expansion that we'll get into in both Pennsylvania and Philadelphia and other places, it applies to multifamily properties as well with more than 5 units, which we'll discuss later. And what the types of projects that it covers are going to be energy efficiency, water conservation, clean energy, and again, with the recent expansion, we're looking at possibilities for indoor air quality improvements, which means reducing exposure to airborne contaminants, and resiliency projects, which means increasing the durability against natural disasters, so flood mitigation and wind resistance and energy storage and possibly microgrids as well. The repayment terms can be up to 30 years, but they can exceed the useful life of the sustainability measures that are taken. And the special assessment that we're talking about here is the form of repayment. So it looks and acts a lot like a property tax, which a lot of you will be familiar with, but it isn't exactly that. And we'll get into that as we go along. And typically, not typically, but universally, the assessment runs with the land, meaning that this borrowing is on the property. It's not traveling with the borrower, so to speak. And the interest rates are very competitive. They're typically coming in at lower interest rates than your standard mezzanine debt, and they are reasonably competitive with principal loan amounts as well, conventional lenders markets. And we believe this is benefited by sort of the special assessment mechanism where the assessments on the property are considered more secure and lower risk, leading to the lower and more competitive rates generally. All right, so as we can see here, nationally, the pace of the program has picked up incredibly over the last several years. Right now, there is CPACE legislation active in about 38 states plus Washington, D.C., and there are programs active, meaning that locally operating borrowing programs and guidelines are active in 30 states plus Washington, D.C. And as you can see, there's a huge jump in the numbers of investment in the last years. In 2022 through September, at least, there's about $4 billion that's been invested in CPACE projects across almost 2,900 commercial projects. And in the last 2 years, there's been massive jumps. From 2020 to 2021, there was a 33% increase in the amount of investment across the country. And from 2021 through 2022, at least through September 2022, we've seen about a 25% increase in the usage of CPACE financing for commercial and multifamily projects. And in terms of that slice of the pie, Pennsylvania accounts for about $83 million that's been invested nationally through CPACE lending. And it's active in about 20 counties in Pennsylvania, meaning that those counties have local guidelines for running the program. So as Lisa talked about, the Philadelphia Energy Authority being the program administrator for the city, this is occurring in about 20 other counties across Pennsylvania where they have local guidelines and operating the program through the various guidelines there. And again, Act 43 of 2022, enacted by the legislature this summer, expanded CPACE to the application of multifamily properties and the indoor air quality and resiliency projects that we talked about on the last slide. And interestingly, in Pennsylvania, we're one of the first states to actually allow for the indoor air quality and resiliency project funding across the lending programs across the country. And before we jump to CPACE in Philadelphia, I just want to make one note about which the panelists will talk about in much more depth later, but the possibility that the legislature believes about $500 million in alternative funding is going to be available to fund housing projects, affordable housing projects focusing on seniors and returning blighted areas back into the market, which is a very useful conversation point, I think, for people to touch on. So focusing in on Philadelphia, as you can see, a large chunk of what's been invested in Pennsylvania as a state is focused right here in the city. Across 10 commercial projects, there's been about $69 million invested. And I think in 2022, the ordinance that was adopted was adapting the CPACE guidelines locally to match the recent expansion by the Pennsylvania legislature. So we'll see as we go along how Philly guidelines match the state's guidelines for operating the program. Okay, and now we'll take a deeper dive into the program requirements for Philadelphia, the process of the borrowing process, and the repayment process in detail. So some of the basic program requirements, you're looking at things like the Philadelphia Energy Authority confirming that the property is in Philadelphia, that the project and the property matches the requirements of the legislature and the local guidelines. So it's a very sort of basic entry point for the program. There is a project minimum for the Philadelphia Energy Authority, which is $100,000. And you'll see that different capital providers also will have different project minimums for the amounts that they're willing to invest. And there's a 95% lien to value limit on those projects. And I think with both the project minimum and the lien to value limit, there are exceptions that can be made on case-by-case basis by the program administrators, depending on the local guidelines. So that's something to keep in mind as you're determining the cost and the value of the projects as you move forward. And capital providers must register statewide with the Sustainable Energy Fund. Currently, there are about 37 capital providers registered in Pennsylvania. So there's pretty much an open market in that sense for borrowers. They're looking for options for capital providers. And as we mentioned, each of them have different minimums for what they'll allow or what they'll sort of enter the market in for investment opportunities. So you have 37 different options in a sense to determine which capital provider is going to be right for the project. And lastly, a major piece of CPACE funding is going to be consent from senior lenders and mortgagees. So the Philadelphia Energy Authority does provide form documents and form language for notifying senior lenders and mortgagees for opening those lines of communication, and for the consent form for the mortgagee is also a form document given by the Philadelphia Energy Authority. And typically in this part of the process, you may see capital providers helping the borrowers to get this over the line, essentially because this is a required part of the borrowing process. The loan, the CPACE financing cannot move forward without the senior lender or mortgagee consent. All right, so now the details, or at least the high-level view of the details of how the program operates. So we mentioned the program requirements a couple of slides ago. Now, another thing is that there's a pre-application and a final application. And the pre-application is really establishing those basic program requirements with the Philadelphia Energy Authority. And in between the pre-application and the final application, a few things are going to happen. The property owner is then going to seek the funding from a capital provider. So in that open market of the 37 options that you have, you're going to shop around and find a capital provider that suits the project. And the property owner and capital provider would then seek the consent from the lien holders, the mortgagees or senior lenders on the property, because that's going to be a required part of going back before that final application. And in there's more details about finding qualified contractors and qualified architects and qualified engineers, qualified inspectors, things like that we won't go into much, but there's a lot more that happens in between. But these are the broad strokes. So once the borrower has filled out the pre-application, found a capital provider, and obtained lien holder consent, they can then go back to the Philadelphia Energy Authority well, what happens now actually with the new guidelines is that there's a conversation that has to take place in between the pre-application and final application with the Philadelphia Energy Authority. So because the recent expansion opens up the market to new borrowers, the Energy Authority is taking measures to have new disclosures in place for borrowers and to require a meeting with the Energy Authority before the final application to ensure that everyone's aware of the requirements of the loan, the repayment process, and all things that go into the borrowing under the program. So then once you get to that final application stage, the city, the property owner, the Philadelphia Energy Authority, and the capital provider. So note that the senior lender is not involved in this part of the process. So this is where the statement of levy and lien agreement comes in between those four parties I just mentioned: the city, the property owner, the energy authority, and the capital provider. So there is no intercreditor agreement in a CPACE funding agreement. So the senior lenders must get comfortable with this statement of levy and lien agreement, which is what governs the relationship between the parties: the borrower, the city, the energy authority, and the capital provider. And that sets the table for the loan, the repayments, the assessments, enforcement, and all those things. So that's a very important piece of the puzzle also. And once that statement of levy and lien agreement is finalized, then the property owner can actually close on the financing agreement with the capital provider, which is sort of the final piece of the puzzle before dispersing of the funds. So you move forward with the project, and in terms of the repayment process, generally, the borrower, as in a typical lending situation, does not repay directly to the capital provider. The funding is repaid through the program administrator, in this case, the Philadelphia Energy Authority. And the Philadelphia Energy Authority then remits that payment back to the capital provider. And again, remember that these payments are special assessments on the property, and they run on the same schedule as real estate taxes in the city. So March 31st of every year, the special assessment on the property will be due to the Philadelphia Energy Authority, who then will remit that payment back to the capital provider, subject to the finance agreement that's in place between the borrower and capital provider. And lastly, we'll wrap up with sort of a brief summary of the costs and benefits of the program. And as you can see on the chart here, the program fees are staggered, but they're also split between a percentage fee based on ranges and a flat fee based on certain ranges. And there, as of February 2022, there's no longer a cap on the program fee from the CPACE financing. So generally, the benefits are lower interest rates and lower program fees, which means a lower cost of capital for the borrowers. You're looking at reduced operating expenses because those energy conservation measures that you have to prove up front, they're reducing the costs associated with operating the property with inefficient systems. So the upgrades are actually saving money on the back end. And there's also an interesting note where you can see here that there's a potential pass-through to commercial tenants, which I'm sure the speakers will get into a bit more if those assessment payments are treated as operating expenses. Lastly, or not lastly, but the loan is a form of non-recourse debt, meaning that there is no action against the property owner. Again, this runs with the land, so that assessment payment sticks until it's paid in full against the property. There's no acceleration of the loan, so I think there's a lot of confusion on if there's a default or if there's a foreclosure upon the lien, that loans are typically accelerated. Well, with CPACE, only what's due and owing at the time is going to be payable. So that remainder of the balance is not accelerated. So that's, I think, a huge selling point for senior lenders and where they get comfortable. And lastly, another benefit of the CPACE financing is retroactive financing available, which is a very particular term in terms of CPACE financing. This is within 730 days after project completion if the project qualifies through those other basic program requirements. There is a possibility of having the funding applied to the energy conservation measures that were taken, which accounting for the decreases in useful life and such that occur over the period of time in between the application and the installation of the features. All right, and now I will kick it back over to Megan to discuss the Golaski Labs case study and as a jumping off point for the panel discussion.
Thanks so much, Fred. So As you heard a lot of us talk about already, Golaski Labs is a development project that used CPACE financing a few years ago. Golaski Labs is located in the Germantown area of Philadelphia. It's a 45,000 square foot mixed use development project. About 25,000 of that square footage is for commercial purposes. That space will house a restaurant, offices, maker space, and a new multicultural co-working space. The remainder of the project will house 41 to 2 bedroom apartments. Leslie, if you could kick us off, could you talk to us a little bit more about Golaski Labs as a general project, and then what you mentioned before, it was COVID and you needed some extra costs. What led you to ultimately decide to use CPACE financing?
Great, yeah, absolutely. So we commenced construction in 2019, and as we all know, COVID came into play. I guess it was around February, March of 2020, and we had to shut down construction. We dealt with everything COVID related. But it's a great project. It's a community-based project. That's why Jean was involved and is involved. Fulton plays very, very aggressively in the space. It's a new market tax credit project, which added a layer of complexity to the CPACE, but Lisa wrapped her head around it and worked with us to figure that all out. With a new market tax credit project, you have more than one funder that really needs to get comfortable with the structure of the project and the funding coming in with CPACE. The primary person that needed to approve it was Jean, because she was the main lender on the project, but the investor that actually puts in equity through the new market tax credit process and what's the word I want to say? The actual structure. They bear some risk also, so they need to be able to lean in and approve it as well. The further complexity for this project, as Megan mentioned, it's a mixed use project. So we have about 50% commercial, 50% residential, and at that time, multifamily had not yet been approved in Philadelphia. So for us to take advantage of the CPACE, we had to then create a condo structure that allowed for those dollars to flow into the project. So that added another layer of complexity that now, thankfully, does not have to happen anymore. But again, we had a group of people, all of which are really here on this panel, who really leaned in to help us figure it out. It really helped because other than CPACE, we would have had to do a capital call on our private investors to bring in additional capital into the project. But fortunately, because we had already designed the project to be above code, we were already installing energy efficient windows. We had already designed our HVAC system to be above code compliant. We had already incorporated LED lighting into our project. Now, what it did do, it didn't just take advantage of what we had already designed, but we also were able to go a step further and put a new roof on a portion of the project that had not been slated to have the new roof put on at that point. It was going to be something that we were going to do later down the road. But it allowed us to go ahead and really do that now, really protect the asset, bring it to another level of energy efficiency by being able to draw down those additional funds. It also contributed to architectural fees, engineering fees. So it's not just relegated to hard construction costs. Some of those dollars can be allocated to soft costs as well. So by going through all of that, we were able to secure that $1,087,000 more of financing at a much more competitive rate than mezzanine financing, as Frederick had mentioned, and tremendously better than having to go out to a capital call to our investors who were looking for an 18% plus IRR on their money. So for us, it was a win-win-win. So for everyone to be willing to kind of figure out all of the complexity of the project, and because it was new markets, because it was multifamily, we did have to get an additional appraisal to appraise just the commercial portion of the project, so that it had to be a complete carve out. There could not be any blending or any kind of capturing any of the value or revenue or cost from the multifamily portion of the project. I was in a unique situation, fortunately, because the multifamily and the commercial parts of the project are not in the same building. They were literally in distinct two buildings, which made structuring the condo a little bit more amenable. Now, I think, Jean, you did a deal where a condo structure had to be created where everything was in the same building. So again, Jean she's all in. She's all in. And so was Lisa. So yes, it saved the day. It allowed us to fill the gap, but also add some features to the project that definitely made it even more energy efficient than had been planned. So for anyone that's looking for, you're in the midst of a construction project that just needs some additional financing, some additional funding, CPACE is definitely a good path and a solid path to follow. I will say, and Jean will talk a bit more about this, in reference to feeling protected with bringing this financing into the capital stack. She did require that the monthly payments be escrowed, so that when that billing cycle comes around, which runs the same time as taxes being paid in the city of Philadelphia, which is typically March of that year, that we would have those dollars set aside, escrowed, collected. So when that time comes, we're prepared to make that payment, because no payments are actually being made throughout the year. It's all collected at one time in March, and you need to be ready for it. So I was actually grateful that Jean made that as a requirement, because it also helps you plan accordingly, so that you're not coming scrambling at January, February, and you've got to make this fairly sizable payment because you haven't been paying it all year long. So that kind of gives you a little bit of background on the particular project. Obviously, as we get further into discussion, I can answer any more in the weeds kind of questions about how it was structured, but I'm going to allow everyone else who's involved in the structure to talk a little bit about the roles that they played in it.
Thanks so much, Leslie. That was great. Jean, I think you are a natural person to speak next about Golaski Labs. How did you get comfortable? Can you talk just a little bit about this particular project?
Sure, I'd be happy to. One of the things that happens knee-jerk when a lender hears the term tax lien is that lenders immediately think about what happens when somebody hasn't paid their taxes and a property's in distress. And so the first thing I think that a banker needs to do is to understand that this statement of levy and lien, while it has the priority of a tax lien that we all dread, it's really not something that we need to fear. So it has been already stated that the amount of the lien is the current year's taxes, or the amount that's due currently is the current year's assessment. It's not the full amount borrowed. In the case of Golaski, the $1,087,000 in CPACE financing is $78,000 a year in terms of its annual assessment. And so that's the amount of the CPACE financing that happens to be ahead of us in priority. I did see the question in the chat, does the statement of levy and lien end up having priority to the senior lender? And it does, but again, it's the 1 year's worth of assessment that's ahead of you. With the rest of it, as Fred stated, it stays with the property. The other things that come up for a lender are how are we going to count the assessment? Are we going to count it as additional debt when we calculate our debt coverage ratio? Are we going to count it as an operating expense? And I count it as an operating expense because it is an assessment. It's similar to taxes. That ends up working out a little more favorably for the borrower. So each bank is going to have to make its own decision around that. Another question that comes up is how do we count the CPACE assessment in terms of loan to value, or as it was stated earlier in the presentation, lien to value, and how is the bank going to get comfortable on the overall? And so where the program allows up to a 95% lien to value, your senior lender may not be comfortable at that level of financing. So that's something certainly to talk through as things progress. In terms of how the bank got comfortable, Fulton Bank has now been involved in Philadelphia. I'm aware of 4 projects where we've consented as a senior lender to CPACE financing. In all of the cases, we felt like it really enhanced the project. 3 of the cases were projects that were already well into construction, and one of them was actually had completed construction, and it was CPACE was brought in retroactively. And one of the projects, it came in fairly early in the project. And I'm starting to see requests where CPACE is now in the initial capital stack. So I think that's really interesting. The interest rate, which was significantly higher than our senior lender debt, is now fairly comparable to what we're charging as a senior lender. So right now, I feel like CPACE is a really excellent option for borrowers to add to their project. And I think I'll stop here and let folks ask questions and maybe respond a little more to questions as they arise.
Thanks so much, Jean. Sheila, can you talk about your role within the Golaski Labs project?
Sure. So first off, I will admit I didn't join the company until after this was financed, but Nuveen was integral in providing the CPACE financing for this project. I have worked on one of those projects Jean mentioned where it was mid-construction, well, still early on, but costs had gone up. And similar to this project, the borrower did not want to go back for a capital call. And so CPACE fit in really well to help fill that increased cost that was missing. Also, as Jean mentioned, back then, there was a lot of room for the debt service coverage. So since CPACE sits as an expense, senior lenders are going to underwrite it. It's an expense, right? Your operating expenses, your real estate taxes, anything that goes with the property has to be paid before their debt. So you have to incorporate it in there, and your debt service coverage will go down if you put a CPACE payment in there, correct? Historically, there was lots of room for that because interest rates were so low. Today, it's changed because now everyone's constrained to that debt service coverage. So when I did this deal with Jean's bank and this one, there was still room in the NOI to just fill in more CPACE. That's not the case today. But because CPACE is a fixed rate financing mechanism, it's fixed at closing and you know what that's going to be when it's stabilized and taken out, you know that payment will be fixed when that time comes. And as interest rates have gone up, our interest rates have also gone up, but not as quickly. So it's funny, you know, we were in like the 66.5% range just a couple months ago. Senior lenders were, 3% SOFR plus maybe 300, and we're like kind of moving really closely with them. And then prime goes up to 6%. So we're lower cost than prime plus 50 bips. Well, we just went out to like a 300, 350 spread. So that's low 7%. Well, SOFR just jumped up to 3.8%. So if they're 300, 350 over, now they're in the same range as us. And so CPACE has become much more of a hedge against those rising interest rates, knowing that it can be fixed throughout construction, whereas that fluctuating interest rate is a little bit feared, I guess, currently in the market. But yeah, so this is a really great tool, I think, for these mid-construction projects, although we also have seen tons for ground up more recently.
Thanks, Sheila. And Lisa, can you wrap up our discussion about Golaski? I know Leslie mentioned your name a lot in coming in on this project and getting comfortable with all the various complexities. What was your role here like, and what do you do on kind of a daily basis with these CPACE projects?
Yeah, sure. Thanks for the question. And actually, before I answer it, I want to say that back in May, or maybe it was April, actually, Megan and Fred wrote an article that was published in the Legal Intelligencer about CPACE in Pennsylvania. And I read it and I reached out to them and I said, this is so great. Like, you've got it all right. Like, they really did their homework. They got it right. They didn't even contact us at the Philadelphia Energy Authority. And so from there is when we decided to create this webinar. So I just want to thank you guys for writing that article and then for hosting this webinar. So I want to mention, related to Golaski and the people who are on this panel, so Sheila represents Nuveen Green Capital. They are the CPACE capital provider, or they were, for Golaski Labs. And in fact, Nuveen has financed 5 of the 10 CPACE projects in Philadelphia so far. But we have, in Pennsylvania, we have an open capital provider market. So we have close to 30 different capital providers that are registered to be CPACE lenders in the Commonwealth. So what we always recommend to property owners and developers, that if they're interested in thinking about CPACE, they should interview several different capital providers, get term sheets from several different capital providers. Obviously, Nuveen is very good at this, and they're getting a lot of the business, but there are other capital providers out there as well. So I just wanted to make that point. So Sheila is making a comment that their minimum financing amount is $2 million right now. So for smaller projects, you're certainly going to want to look to some other capital providers. Although that is the minimum for a number. And so if you have a smaller project than 2 million, definitely contact me and I can help you find the right capital provider for you. And that's true in any case, no matter what the size of your project. That's one of the roles that that my colleague Matt and I play at the Philadelphia Energy Authority, is to help you find the right capital provider through this open system. And so I also just wanted to, Leslie did say that she said that we know that, okay, let me start again. Multifamily properties are now eligible for CPACE financing. They weren't when Golaski Labs got financed. So the significant amount of complexity that Leslie spoke to is now gone. We do not need to worry about that anymore. So it's much simpler. Mixed-use buildings, all multifamily, all commercial, industrial, agricultural, are all eligible for CPACE. The one thing that isn't eligible is residential units of 4 units, residential facilities of 4 units or less. One of the questions in the Q&A is, can you do this for green homes? And this is not a residential PACE program, it's a commercial PACE program. So it is, so that kind of program, that is not eligible for financing through CPACE. The other thing I want to mention is that and there was another question about somebody, Dante asked if hempcrete is allowable instead of using concrete. So that question, I want to answer that at a different level, which is that every project, if the funding is for energy efficiency and or water efficiency, an energy survey must be completed. And that energy survey shows what the baseline being the Philadelphia energy code is and how your project is going to be more efficient, use less energy than what the Philadelphia building energy code requires. So you can use any materials you want as long as they are, as long as you meet, building code, and that overall your whole building energy performance is above code. Or you can go for particular measures if you want. But so far we have seen two exceptions. So most of the energy surveys we've seen have been whole building level. So an energy model of the building, which is typically what you'll need to do anyway to get a building permit. We had two projects. One was a replacement of a boiler system and a chiller system. So that didn't use whole building. That was just looking at the swap out of an old system with a new system. And then we also had one solar system, which obviously you're not looking at whole building energy savings. You're looking at the amount of energy produced on site. I'm going to say one more thing, and then I can't wait till we get into some more conversation here, discussion, is that so what I do as the program administrator is I help connect property owners and developers with the different resources they need, and then we help and review applications. And the applications have many different component parts. The capital providers usually are working, very directly and hands-on with the property owners to develop those applications. And then we review and approve those applications. And then ultimately we are involved with getting signatures on the statement of levy and lien and recording that with the city. So I am going to stop talking now, and I'm going to look at the questions and be ready to answer more of them when that time comes. Thank you.
I'm just going to jump in real quickly, if you don't mind. Lisa, you may want to also mention the energy report that needs to be completed. And you were really helpful with providing us with some options of the people that actually do that modeling. But that was a requirement as well. Yeah.
Yes, that's the energy survey I was speaking of. So we call it a report or a survey. And yes, we have a list of the qualified engineering professionals who've already asked to be on our list, and you can find one there. We can also help find the right match for you. Yes, but that is, and with resiliency and indoor air quality, a different type of survey will be required if you're looking to fund those kinds of projects.
Lisa, thank you. And Leslie, that was a great point, something I was actually going to ask Lisa about. Anyway, so I'm glad that you did. We actually have a number of questions. There's been some back and forth between some of the attendees, and Fred's been answering questions, but I wanted to just maybe kick us off here with a couple of these so that we make sure we have time to get to any of them. Someone asked if there are project labor requirements, example, prevailing wages. Lisa, I think maybe you're the best person to speak to this.
There are not prevailing wage requirements.
Great. And then I think, Jean, you might have touched on this. Would using hempcrete be allowable instead of using concrete? Did you touch on that?
I think Lisa did.
Yeah, I talked about that the materials are, it's how the materials can contribute to making your building more energy efficient. So we look at the total energy efficiency of a property, not the building materials themselves.
Great. And then Jean, there's a specific question for you. What's the percentage of projects that have come to your bank for CPACE consent and to which it has agreed?
As far as I know, we've agreed to all of the ones who've requested that we consent to CPACE. The question is really going to be more about whether the project makes sense and whether the capital stack makes sense, and whether the bank is going to be comfortable that there's enough cash flow to pay everybody that needs to be paid. So that's really what you should be concerned about if you're trying to add CPACE as another layer of financing, whether the property has sufficient cash flow to make everybody happy.
Great. And then Jean or Sheila, maybe, and another question that just came in is whether there's prepayment penalties associated.
Yeah, so I'm not sure, I won't speak to other lenders, but we have prepayment penalties, and it's a step down like a bank would charge, but it's negotiable. For us, we require a certain type of revenue for each investment we make. And so between origination fee, prepayment penalty, and the spread, if one goes up, another might have to go down, or if one goes down, another will have to go up. But there is flexibility in that if necessary or requested.
Great, thanks. And I believe the final question that was in here that was just a clarification that the original question was about commercial greenhouses versus greenhouses residential. And I believe, Lisa, you can correct me if I'm wrong. The answer is yes, that agricultural CPACE financing would be applicable to a greenhouse facility.
Yes, that is correct. I misread that original question. I also want to say regarding the consenting lenders, in Pennsylvania, we've had, for all the projects in Pennsylvania, so far there have been 18 different financial institutions that have consented, some multiple times, like Fulton. And nationwide, there have been hundreds. Sheila might know what the actual number is, but many, many hundreds. And so the other thing that I say about that is, if you're a developer, a property owner who's thinking about CPACE, I recommend highly that before you talk to your senior lenders or lender, that you first have a conversation with your capital provider and bring the capital provider, the CPACE capital provider, into that conversation, because they are much more experienced at having those conversations and understand like how to talk to your senior lenders about it, where in a way that as a developer, property owner, unless you've done it before, you probably are not going to be able to address all the issues that come up.
Yeah, I did want to mention what Lisa just said there. There have been times when a capital provider or a senior lender consented historically with a couple projects, and a lender, they're all different in different locations, would bring in a CPACE loan and not present it with all the facts. So, our loan payment is not senior to the mortgage. Our loan amount is not senior to the mortgage, just the payment for that year, like any other real estate tax, like any other ground lease would be, as long as they know how to underwrite it within their loan parameters, there should be some level of comfort at some point, right? And what's happened is I've seen it where a lender comes in misinformed and they stop all CPACE loans with the senior bank. Then another lender will have to come in and actually have to pitch a white paper and help do some damage control to then get senior management to understand what CPACE is and how it works, to then help open it back up. And so sometimes when you come across these loans, it's really helpful to make sure that the lender that you're talking to has all the information before they present it, because it could cause issues for not just this loan, but future loans.
I'd just like to echo that and agree with Lisa and Sheila about about working with the capital provider and the senior lender. The capital provider in the first CPACE deal that I was involved with was instrumental in providing the education that I needed, my team needed, and then I was able to filter up through our credit officers to get the authority to consent to CPACE. And without talking with a capital provider that we knew through other types of financing and feeling comfortable that we could rely on what they were telling us and then doing our own investigation to also get comfortable that we knew what we were talking about when we went to talk with our credit officers. It would have been a much more difficult conversation to have. And internally, I've become a little bit of the CPACE expert. So when other lenders in the bank have CPACE deals, I oftentimes will get a call, and I'm happy to help them understand how to underwrite it.
Thanks. Another question, we actually have a bunch of other questions that have popped in, which is great. I'm glad so many people have questions for these panelists. You're not going to get better answers anywhere else. So keep asking away. The next question was, if the tax bill and bond are not paid, what eventually happens if the tax certificates are sold? Lisa, probably.
So I'm not sure if I'm going to answer this precisely, but if the CPACE assessment is not paid and is delinquent, eventually there can be a sheriff's sale to pay that off. However, if they're delinquent, probably everything else associated with that property is also delinquent, and the senior lender is probably going to be taking action before the CPACE lender would be. So again, it's only the current amount that's due. It doesn't accelerate, just like a property tax bill. You don't owe your 2030 property taxes now. You only owe your 2021 and 2022 tax bills. So and so then if there is some kind of a default or a bankruptcy and there's a sale, the new owner of the property acquires, basically keeps that assessment that's on the property, and they are responsible for continuing to pay the CPACE assessment unless it's paid off during some kind of a delinquency proceeding.
Yeah, and let me mention, I was just going to say, we are long-term fixed rate money. We don't want to get prepaid. We're relying on these payments to be paid when they come due, right? If there's no acceleration, if there is a foreclosure or the payments are not being paid, we are not looking to step in and say we want our money back. We don't have the right to, we're not allowed to, and we don't even want to. We want the payments to be paid for the life of the loan, because we are a pension fund which matches assets and liabilities. So in this instance, we rely solely or largely on the county or the municipal entity to step in and say, look, you haven't paid your taxes, CPACE or taxes, they need to be paid, right? And so we kind of sit behind them and wait for them to step in and say, you need to pay these payments.
And what I was going to add is that as a property owner or somebody involved in the CPACE transaction, you need to understand that having this assessment, having this bill that comes up annually is going to affect the marketability of the property. If it comes to a sale and the buyer has to have an additional expense for money that they don't feel like they necessarily received, it will affect what they're willing to pay for the property. I think there's a similar concept that comes into play when we talk about passing the CPACE along to a commercial tenant as part of operating expenses. Again, you're in a competitive marketplace and your tenants are only going to take so much in terms of their operating expense share of the property before it starts impacting your lease rates. So it's not necessarily free money. It has to be considered, but it's still a great form of financing as long as you are considering it carefully and understanding how the financing impacts the potential value of the property and what happens upon a foreclosure or sale.
Jean, while you're on the mic, there's another question. Do senior lenders require cure rights on CPACE defaults?
I don't think, I don't know. I'm going to pass that off. I don't think we required it. I think it's a great idea. But I think as with a tax lien, we'd likely be in a situation where we would just, if our loan was also in default, where we would pay the current year assessment, and then we would have the senior position in terms of a foreclosure. Does that make sense?
Yeah. Okay. Lisa, I think there's another question I was going to direct to you. Does CPACE have successful examples of working with Freddie Mac?
So we haven't actually had a multifamily project close yet because it is so new in our market. And I'm actually going to defer to Sheila on what that's been like nationwide.
I've talked to Jeremy multiple times on this topic. From what I've been told, Freddie Mac is working on their guidelines. They are a large institution. And so it takes time for them to come up with what they will allow and won't allow. I know Fannie Mae right now, their stance is a hard no. But CPACE is still new. It's still in its infancy when it comes to ground-up construction financing. In the past, it was always used for retrofits. So a project that's already completed wants to replace the roof, replace the lighting, and CPACE would come in for that. Ground-up construction is newer in what they've allowed for CPACE, and so there hasn't been a ton of projects that have been completed and refied out. Where Fannie and Freddie, they're all long-term, fixed-rate, permanent financing for post-construction. We've also heard, like from my team, we've been informed that there's a handful of loans that were completed in California that use the 223F HUD program for their takeout financing. We have not done it, and we are researching and looking into that to make sure we can find out who's done it and inform the borrower. There are guidelines that have been created to explain how to underwrite CPACE for HUD loans, and I do have that guideline. I just don't know of the loans that have been utilized or have been financed utilizing those guidelines.
And has it only been 223, not 221, right? 221 D4s are new construction as opposed to rehabs. Okay.
Yeah, correct. No 221 D4s will allow it right now.
Okay, so our hour went by so quickly. I can't believe that it's 1 p.m. already. There was one final question in here. If CPACE is tied to the project, will the developer be restricted from selling the project? Short answer there is no. They can still sell even if the CPACE financing is attached to the project. It just runs with the land. So that's an additional liability that your purchaser would be taking on. I believe that answered all the questions in the chat. And again, we somehow made it to 1 p.m. in record time. I did want to mention before we jump off here that Lisa has graciously offered up her email address. If anyone has additional questions that didn't get answered here, she's obviously a wonderful resource for Philadelphia projects, and I'm sure even projects that might be outside of Philadelphia, she'd be happy to share her experiences and insight. And Lisa can be reached at cpace@philaenergy.org. If anyone has any other questions, again, for any of our specific panelists, feel free to reach out to Fred or myself, and we are more than happy to connect you directly with Jean or Sheila or Leslie or Lisa if you didn't catch her email address. We really thank everyone for joining us today, and a special thanks to all of our panelists for carving out some time to talk with us today. It was a great discussion, and really thanks to all of our attendees because you really spearheaded most of our dialogue here with your wonderful questions. Thanks again. Have a great day, everybody.
Everyone.